Getting paid by international clients used to feel like navigating a cargo ship through a narrow canal. Every transaction scraped against forex markups, compliance checks, and routing delays. Success for an Indian business in 2026 depends on moving foreign revenue into a local bank account with total predictability. The real friction today happens when you rely on older cross-border tools that force your business to bend to their rules rather than adapting to how you actually sell. If your payment tool doesn't match your billing model, you end up with frustrated international buyers, abandoned checkouts, and margins lost to invisible fees. Finding the exact right payment processor comes down to a single question: how do you acquire your customers? Look at this decision tree. If your revenue sits on the left side, you rely on high-volume marketplace sales, selling products through global platforms like Amazon US, eBay, or Shopify. If you fall on the right side, you run a direct billing model. You might be a SaaS founder, an agency, or a direct-to-consumer brand, which means you own the relationship with the customer directly. Being on this right side requires specific tools. You have to be able to accept direct credit card checkouts, send custom payment links, and offer buy now, pay later options like Klarna to close higher ticket deals. If you choose a processor without knowing exactly where you sit on this tree, you'll end up running your business on infrastructure built for a completely different buyer journey. Let's look at PingPong. Founded in 2015, it became the default standard built explicitly for e-commerce sellers on global marketplaces. Connect PingPong to your Amazon or Etsy account, and funds settle automatically from the marketplace into your Indian bank account without you lifting a finger. But that convenience comes with a cost structure you don't control. PingPong uses an opaque, variable fee model. Depending on the currency and the specific corridor, you are typically paying anywhere between 1 and 2% per receipt, and you often have to call sales just to get a real quote. When things get stuck, their customer support is routed across global time zones in China, New York, or Europe. For an Indian business working local hours, that means waiting overnight to resolve a block on your cash flow. Even getting an account requires heavy documentation tied to marketplace seller verification. If you're a freelancer, that onboarding process can stop you in your tracks. Most importantly, PingPong lacks basic retail features. You cannot process direct Visa or Apple Pay checkouts from clients, and there is absolutely no native automated subscription billing. PingPong works beautifully if you sell on Amazon, but if you own the client relationship directly, its architecture becomes a rigid bottleneck. That brings us to platforms engineered strictly for direct B2B invoicing, specifically Skydo and Carbon. These tools are designed for freelancers and agencies who receive large, structured wire transfers into virtual bank accounts. This chart compares the net rupees you keep on a $5,000 direct agency retainer. PingPong takes a variable cut of roughly $50 or more. Skydo takes a flat $29. On high-ticket wires, flat fees guarantee predictability and keep more money in your pocket. But the trade-off for that flat rate is absolute rigidity in how you collect that money. You cannot accept a consumer credit card. You cannot run a monthly SaaS subscription. You cannot text a payment link to a client via WhatsApp.
They do one thing: bank transfers, and nothing else. Wire specialists maximize your margin on massive, one-off invoices. They fall completely flat if you need to modernize the checkout experience for a retail buyer or a SaaS buyer. If your business requires automated recurring subscriptions and direct consumer payment methods, you need a full-stack solution. This is the gap Playto Pay was engineered to fill. It combines the low-fee structure of wire specialists with the checkout capabilities of consumer gateways. Look at this checklist comparing PingPong, Skydo, and Playto Pay. Playto Pay is the only one checking all 4 boxes: direct card acceptance, native subscriptions, buy now, pay later, and domestic UPI. For a SaaS founder, that second column is everything. You can automate monthly international credit card charges without ever sending a manual invoice or chasing a client for a wire transfer. Finally, notice that 4th column. You get a single, unified dashboard that manages both your international card flow and your local Indian UPI and RuPay payments. Deploying a full-stack approach means you stop duct-taping 3 disconnected tools together just to process your global and domestic revenue streams. Stop looking for a universal best cross-border platform. The right choice depends entirely on mapping your specific business model against the available infrastructure. Here is the current cross-border ecosystem mapped out. The vertical axis measures your billing complexity.
from simple invoices up to recurring subscriptions. The horizontal axis tracks how your customers pay, from wires on the left to cards and UPI on the right. If your primary revenue comes from an e-commerce marketplace like Amazon, you land in the bottom left. Keep PingPong exclusively. The automated settlement from the marketplace easily outweighs their opaque pricing. If you run an agency dealing exclusively in large, structured B2B wire transfers and you never plan to accept retail credit cards, you sit in the top left. Go with Skydo. But if you are a SaaS founder, a DTC brand, or a course creator requiring flat-rate card acceptance, automated subscriptions, and domestic UPI in a single view, you belong in the top right quadrant. You need to migrate to Playto Pay. The correct choice simply aligns your back-end financial infrastructure with exactly how your end customer prefers to pay. Transitioning to a full-stack solution doesn't mean flipping a switch and risking your current cash flow. You don't need a hard cutoff. The smartest protocol is to run both your legacy system and your new platform in parallel for a 4 to 6 week testing window. This setup guarantees zero disruption to your existing marketplace settlements. Meanwhile, you can safely onboard all new direct clients using your updated payment links. You will have to manage 2 separate reconciliation dashboards during this window. That is the temporary trade-off for a risk-free transition. Once you fully transition and close the old account, make sure you download and retain all past FIRA documentation for 7 years. Indian tax law requires it. Upgrading your payment infrastructure is a strategic step toward unblocking global revenue growth in 2026.